The geopolitical landscape of early 2026 is not merely a volatile environment for the casual observer, but a catastrophic dislocation event for the allocated capital of the institutional investor, and we are no longer looking at isolated geopolitical skirmishes, but rather a synchronized systemic liquidation of the post-Cold War economic order that demands an immediate and aggressive restructuring of every major portfolio. The daily news cycle focuses on the human drama of protests in Tehran or troop movements in Caracas. But for the macro strategist, this noise is irrelevant because the only signal that matters is the cohesive and terrifying logic of capital flight and asset repricing driven by the violent repartitioning of global energy assets, the weaponization of critical supply chains, and the potential disintegration of nuclear-armed states. As of January 12, 2026, the United States stands at the epicenter of a geopolitical storm that is not just a threat to national security but a direct assault on the supremacy of the dollar and the risk-free rate status of U.S. Treasuries, meaning that the assumptions holding up the valuations of the S&P 500 and the credit spreads in the high-yield bond market are effectively null and void. The media narrative suggests manageable foreign policy challenges, but the forensic analysis reveals a market environment where the protagonists are running out of liquidity, and the economic consequences for the U.S. consumer and investor are an imminent margin call on a leveraged system. We are identifying 4 high-impact developing situations that are not merely events, but tectonic shifts in the cost of capital and the availability of leverage, starting with the Venezuela paradox, which is a masterclass in how a political victory can trigger a sector-wide bankruptcy event. The U.S. military intervention in Venezuela, resulting in the capture of Maduro, is being sold as a victory for democracy, but from a trading desk perspective, it is a massive short signal for the U.S. shale industry because it threatens to flood the Gulf Coast with the heavy sour crude that complex refineries actually want, effectively bankrupting the light sweet shale producers who have been surviving on an artificial scarcity premium. This is a complex interplay of geology, chemistry, and finance, where the trade is to short the debt of Permian Basin drillers and go long the crack spreads of complex refiners like Valero and Phillips 66, who are about to see their input costs collapse while their product margins expand. The arrival of Maduro in New York is the end of the Chavista monopoly, but the beginning of a liquidity crisis for American independent oil producers because the global oil market is segmented by quality, specifically density and sulfur content, and the U.S. shale revolution produced too much light sweet oil, while the U.S. refining complex was built for heavy sour sludge. The hidden angle here is that the reintroduction of Venezuelan heavy crude is a hostile takeover of the feedstock supply chain that will displace the expensive cocktails of blended shale oil that refiners have been forced to buy, meaning demand for WTI will plummet relative to Brent, and the spread will blow out to levels that make drilling in North Dakota uneconomic. This explains why stocks like Diamondback Energy and Devon Energy crashed on the news, because the smart money knows that if Gulf Coast refineries can access cheap, high-margin Venezuelan heavy oil, they will stop buying the light shale oil produced in Texas, leading to a supply glut of the specific type of oil U.S. rivals produce. Furthermore, the notion that Venezuelan production can be turned on in a weekend is a myth that creates a dangerous interregnum period where the expectation of future supply depresses prices today, crushing the cash flow of U.S. producers, while the actual supply is not yet available to lower gas prices for consumers, creating a stagflationary nightmare of falling corporate profits and sticky consumer inflation? This leads to Shale Bust 2.0, where the economic contagion moves from the oil fields to the regional banking sector, because the US shale industry is a debt-laden beast, and if prices drop below the break-even point of $60 to $70 for new wells, the drilling stops and the defaults on energy junk bonds begin triggering a credit event that could rival the 2016 slowdown, but with higher interest rates. The economics of U.S. oil production are precarious, with WTI trading around $56 a barrel, meaning many producers are operating on razor-thin margins and eating their own seed corn by producing from existing assets without the capital incentive to replace them. So the introduction of Venezuelan heavy crude creates a substitution effect that drives down the price of WTI relative to global benchmarks, specifically hurting U.S. domestic producers and undermining the energy dominance narrative that has supported the dollar for the last decade. Beyond the domestic economic impact, the intervention is a direct move against Chinese influence, effectively expropriating a Chinese energy asset and signaling a return to resource nationalism that will force Beijing to retaliate in other sectors, specifically the critical minerals required for the U.S. energy transition and defense, which brings us to the second crisis, the rare earth stranglehold. China's expansion of export bans on critical minerals is a calculated silent blockade designed to starve the U.S. defense industrial base, and this is not a trade dispute, but a kinetic preparation disguised as trade policy that targets the processing technology rather than just the raw ore, initiating a decoupling that effectively renders the U.S. incapable of manufacturing the guidance systems for its own missiles. The G7 emergency meeting called by the U.S. Treasury is a recognition that the West is running out of the raw materials needed to defend itself, and the capital markets are woefully underpricing the inflationary impact of this supply shock. Because if you cannot get dysprosium and terbium, you cannot build the permanent magnets for F-35s or JDAMs, and if you cannot get gallium and germanium, you cannot build the ASA radars that give U.S. warships their edge. The specific targeting of the process, not just the product, is a checkmate move, because even if the U.S. mines its own rare earths, it lacks the refining capacity, which takes a decade to build, meaning there is a window of vulnerability where the cost of defense procurement will skyrocket and the production timelines will stretch into infinity. This creates a hollow force reality where the U.S. viewer believes their tax dollars pay for a top-tier military, but they are actually funding a force that has been hollowed out by supply chain dependency, and this creates an inflationary supercycle because the green transition relies on the same minerals, meaning the Fed will be forced to choose between sacrificing the climate agenda to save the defense base or bidding up the price of scarce resources and fueling a new wave of inflation that makes rate cuts impossible. The third crisis is the Persian nuclear anarchy, where the protests in Iran have moved to a pre-revolutionary phase, raising the specter of loose nukes falling into the hands of factionalized IRGC warlords, which is the single greatest threat of nuclear terrorism since the collapse of the Soviet Union and a black swan event that no risk model is currently capturing. The collapse of the Iranian rial and the burning of government buildings in Mashhad and Qom indicate that the regime is fracturing, and if the central authority disintegrates, we face the nightmare scenario of lost command and control over enriched uranium stockpiles, which would trigger an immediate terrorist premium in global markets, causing capital to flee into gold, the Swiss franc, and U.S. Treasury bills, despite the fiscal issues. The oil spike in this scenario would be instantaneous and violent, because a dying regime or a desperate faction could mine the Strait of Hormuz or launch missile barrages at Saudi infrastructure to burn the house down on their way out, sending oil to $150 a barrel and triggering an immediate global recession that would wipe out equity portfolios overnight. U.S. intelligence is frantically reassessing this because the threat of nuclear terrorism on U.S. soil moves from theoretical to imminent, leading to a potential draconian lockdown of U.S. borders and ports that would strangle the economy and destroy the velocity of money. The fourth crisis is the Cape of Conflict, where the permanent closure of the Red Sea has shifted the center of gravity to the Cape of Good Hope, and the naval exercises by Russia, China, and Iran in South African waters are a declaration that the West no longer controls the world's most vital logistical choke point, marking a return to naval competition that creates a permanent distance tax on global trade. The shipping industry has quietly accepted that the Red Sea is dead for Western transit, meaning traffic through Suez is down 90%, and the world's logistics have structurally shifted to the long route around Africa, adding 10 days to the journey and increasing shipping costs by 50%, which is now a permanent embedded cost in every sneaker, laptop, and car part imported from Asia. The BRICS nations know this and are pivoting their military projection to the Cape to control the new primary artery of trade, meaning that if South Africa denies access to Western shipping under pressure from its partners, the global supply chain would face a catastrophic seizure that would empty shelves within weeks and spike the consumer price index beyond anything seen in the post-COVID era. This is a return to cost-push inflation that central banks cannot fight with interest rates because you cannot print ships and you cannot print safe passage through contested waters, meaning the bond market is going to riot as yields push higher to compensate for the structural risk in the global economy. The convergence of these four trends creates a perilous environment for the United States, where the peace dividend is officially over and the economy is now a theater of conflict where investors must look for resilience and hedge against volatility by diversifying into real assets and strategic commodities, specifically the non-Chinese processed rare earths that will become the new hard currency of the 21st century. The correlation between asset classes is breaking down, and the traditional 60-40 portfolio is dead because both stocks and bonds will suffer in an environment of supply chain breaks and oil gluts. So the smart money is moving into complex refining capacity and fleeing pure-play shale producers while watching the shipping volume data around the Cape of Good Hope as the real-time heartbeat of the global economy. The economic warning is flashing red, and the era of compartmentalized risk is over because we have moved from a state of competition to a state of conflict where the battlefield is everywhere, from the gas pump to the semiconductor fab, and the only question is whether you are positioned to profit from the fracture or if you will be the liquidity that the smart money uses to exit the burning theater.